Welcome to the short executive knowledge lecture on topic 5, paper 2 of the SFC licensing exams. This topic covers other securities activities, and as it says, it's those activities other than the ones that have been covered in other topics. I will emphasize the important points to help you understand the core material you need to know to sit the exam. Copy of the study notes you see on the screen can be downloaded from the Executive Knowledge website under Paper 2 Resources. And as ever, I strongly recommend that you supplement this learning with question practice that is provided by Examinator.online. Let's look at what is covered in topic 5. Approved introducing agent. There seems almost always a question on that section, and I'll cover that in a moment. Securities margin financing, that's the type 8 activity. Yes, there will be something coming up on that. We have to be prepared, as with short selling. So the first 3 sections often have a question. So you're probably only going to have 2 or 3 more questions from topic 5. So I wouldn't be concerning myself with knowing all this material, certainly the first 3 sections. Securities borrowing and lending, we'll see that is linked to short selling. And section 5, advising on securities type 4. And that is one of the 4 activities covered by paper 2. So it's well worth being comfortable with that section. Then we come to some of the more detailed, section 6, online trading and advising on securities. Number 7, alternative liquidity pools. This has started to be examined, so I will highlight the main points that you need to know there. Automated trading services, that's type 7 activity, outside chance nowadays of being examined. And then offers of securities, as we'll see, there's 2 types of offers of securities to the public. One is the collective investment schemes and the other is listings, new shares being offered to the market. Section 10 looks at cross-border trading. That is the Shanghai and Shenzhen Stock Connects. And I'll pick out the points that have been examined in the past. And then a new, or a relatively new, section on virtual assets, yet to be examined, but let's have a look at the main points that we should consider. Okay, so as I've indicated, I'm going to go through in a certain amount of depth the first 3 to 4 sections, and then I'll start skipping through. Section 1, approved introducing agent. Yeah, I would just know this. The approved introducing agent is someone that introduces investors to dealers. It could be an asset manager, for example, that introduces an investor to a specific dealer. Now, if that is the case, you must be type 1 licensed, even though, and the first 3 sub-bullet points, top of page 5, you only conduct business of receiving and passing on client trades or introducing client to stock exchange participant. You do not handle client assets and you incur no legal liability on introduced business. Those 3 points have to be satisfied to be considered an approved introducing agent. You will need a type 1 license, but the big deal is that your liquid capital requirement is 500,000, not 3 million as with securities dealers. And then other requirements under 1.3 must comply with rules of on handling. You do not need to. I beg your pardon. You do not need to comply with rules on handling of client securities and money because you do not handle either securities or money. You do not need to issue contract notes or receipts to the client, and you do not need to contribute to investor compensation fund. So there are 3 points, 1.1 to 1.3. I would know those for the exam because they will be covered. There's a good chance they'll be covered by 1 question. We now move on to securities margin financing. That is the type 8 regulated activity. Now, there are pages of this material because it's recently been upgraded. I will highlight the main points you need to know. By all means, read all the detail, but it's not all going to be examined. Now, the definition is important. It's a bit wordy. It tells us that securities margin financing is the provision of financial accommodation to facilitate. What on earth does that mean? It means to lend. So a financier lends for the acquisition of listed securities anywhere in the world and the continued holding of listed securities. So, put simply, securities margin financing is lending investors money to enable them to buy and hold listed securities. And often the practice is that the investor will provide those securities as collateral for the lending. Now, the amount of money that is not borrowed and is put in by the investor, him or herself, that is the margin that they are contributing. Now, who needs a Type 8 license? It is somebody that really is not regulated elsewhere. So it's somebody that sets up, has some lines of credit, borrows from banks, lends to investors, takes their investments as collateral, and then uses that as security to the banks for borrowing the money. Now, you may not be a bank, the person may not be a bank, may not be a dealer. Those are the situations in which you would need to be licensed for a Type 8 regulated activity, because the SFC wants to make sure that you operate all the required systems, procedures, and risk management. Now, having said that, let's look at those entities that are exempt from the Type 8 license, and they'll be exempt because they are regulated elsewhere. First point, for underwriting, sub-underwriting, acquisition under a prospectus. So that's specifically lending for in a listing situation. You do not need Type 8. For a Type 1 licensee, that is the securities dealers, you're already licensed. SFC is already regulating you. And it's where you are lending money to your own dealing clients to enable them to buy on the margin. They don't need Type 8. Now, it's to be sort of pernickety, if a Type 1 licensee started lending to non-dealing clients, just clients that they're lending money to, then technically they would need a Type 8 license. Next one, to finance investment in collective investment scheme by collective investment scheme issuer. That's where you're gearing up the scheme that you do not need a Type 8 for. And then, to my mind, the big one for AFIs, for holdings by its clients, that's banks. So banks that are lending money to clients to enable them to buy securities, they don't need a Type 8 license. They've got the HKMA all over them, regulating them with regard to being a banking entity. And then last one there, well, the last two, by an individual to company which he owns more than 10%, and by an intermediary that provides an introduction to a related company. I wouldn't worry about those two. The ones that I've seen pop up in questions for underwriting, sub-underwriting, etc., for the Type 1 licensee and for AFIs. So I would say already we've hit maybe a couple of possible questions in the exam. Definition of what securities margin financing is, the fact that it's for securities anywhere in the world, not just Hong Kong, listed securities, and it covers the continued holding of those securities. And then there's some bits and pieces towards the end of 2.1. Now, as I said, no, I did not say, I'm tying myself up with approved introducing agent. Financial resource requirements, section 2.2 for securities margin financiers. Their paid up capital minimum is 10 million as opposed to 5 million for dealers. Now, we covered that in topic 2. Their minimum liquid capital requirement is 3 million, and that's standard for dealers. And there's some other bits and pieces with regard to financial resource requirements. Now, the driving force behind the regulation of the Type 8 licensee is that the SFC wants such financiers to act like banks. They're not regulated by the HKMA, but the SFC wants to make sure they have the controls, procedures, processes in there to mitigate the risk of lending money. So what we will see now is all the procedures and controls that the SFC expects securities margin financiers, pure financiers, that's the Type 8 licensees, to have in place. And that is what you will see under sections 2.3, 2.4, 2.5, and 2.5 covers leverage, concentration risks, margin calls under 2.51, 2, and 3. 2.4 covering haircuts, stress testing, and notification. Now, all of that comes from recent standards, recent codes that have been put forward. Do I need to know all of that? I would read through it, but there's no way they're going to test all of that. I've really highlighted the main points at the beginning of this section. Read through and then do the practice questions. 2.6, the subsidiary legislation that relates to securities margin financing, contract note rules, and the client securities rules, which a little bit of overlap there with topic 2. Okay, so that's what I'm going to say about securities margin financing. As you can tell, it's fairly broad. 1, maybe 2 questions in the exam. Section 3, definitely short selling will be examined because short selling is the Achilles heel of Hong Kong. Back in 1998, we had major problems with wave after wave of naked short selling, which brought the Hang Seng Index down 50% in 4 days. So the Hong Kong regulators are very sensitive about naked short selling. Let's look at some of the definitions at the top of page 10. Short selling, selling securities which you do not own. Well, how does that operate? Well, you sell them and then a little later, hoping that the price has fallen, you buy them and then on the same account you net off the two and just take, hopefully, the profit. Covered short sale is where seller can deliver stock on settlement, usually through stock borrowing. You are covered, whereas the naked short sell is where you have no access to the securities in question. I want to go to the box under section 3.2. It says, however, short selling is permitted if it is a covered short sale. A person shall not sell securities through a recognized stock market unless the time he sells or she sells them, he or his principal employer has, or he believes he or his principal has, a presently exercisable and unconditional right to vest the securities in the buyer. So you can get hold of those securities. The idea is if anything goes horribly wrong, well, what would go wrong is that you sell the security, the price goes up, you cannot go, well, you're unlikely to go into the market and buy at a higher price. You've borrowed, for example, you've borrowed the security to cover yourself, so use those borrowed securities to complete the sale. It goes without saying that naked short selling is illegal. You are breaking the law in Hong Kong. What other points do I wish to highlight? 3.6. Notes, these are guidance notes. The notes clarify that the following are not short sellers. Sale is preceded by purchase, but seller has not yet received stock. Seller is given irrevocable instructions to convert options or other convertibles to securities before sale of underlying securities and the purchase of Hong Kong listed securities on an overseas exchange and they're later sold. So that clarifies those individuals are not short sellers. What I want to specifically highlight is under 3.7, the second bullet point. Only covered short sales are permitted where sellers entered into a securities borrowing and lending agreement. That's by far and away the most common way of covering a short sale. Secondly, You have a title to another security which is convertible or exchangeable for the security being sold. And that's convertible bond and exchangeable bond, but they have to be convertible, exchangeable now. An option to acquire the security, and that's your call option. But please be aware it has to be an American style call option, not a European style, because the European style call option can only be exercised at the end of the life of the option. No, it has to be presently exercisable. And rights or warrants to subscribe for and receive the security. Section 3.8 points out that at certain levels, financial criteria, brokers will have to report the short positions they hold, and read the detail that we have there.